Hi traders, welcome to another collaboration video between Bar Chart and Options Trading IQ. My name is Gavin McMaster. I'm the founder of Options Trading IQ, and today we're going to be talking about the short straddle option strategy. Before we do that, just a quick disclaimer that everything discussed today is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So what is a short straddle? A short straddle is an advanced option strategy used when a trader is seeking to profit from an underlying stock trading in a narrow range. To execute the strategy, a trader would sell a call and a put with the following conditions. Both options must have the same underlying stock. Both options must have the same expiration. Both options must have the same strike price. Since it involves selling both a call and a put, the trader gets to collect two premiums up front, which also happens to be the maximum gain possible. Due to the two premiums collected, beginners are often attracted to this strategy without realizing the risks. A short straddle has unlimited loss potential, so it should be used with caution, particularly around significant market events like an earnings announcement. The opening position of this strategy means that you will start with a net credit and you will profit if the stock stays between the lower break-even point and the upper break-even point. Losses accrue if the underlying stock makes a substantial move to either the downside or the upside, with potentially unlimited losses. Just like an iron condor, which we've looked at previously, the idea is that majority of the time stocks are going to stay within a specified range, about 68% of the time within a 1 standard deviation range, and about 94% of the time within a 2 standard deviation move. So, like iron condors, the first thing we can do is scan for stocks with a high implied volatility. The short straddle aims to profit from a drop in implied volatility, with the stock staying within an expected range. When implied volatility is high, the wider the expected range becomes. So here's a sample scan that you can use on bar chart as a good way to find highly liquid stocks that have a high IV rank or IV percentile. These are the results from today, Monday the 21st of November. So we can see that Salesforce has the highest IV percentage and also has a high IV rank. Part of that is because earnings is coming up on the 30th of November in about 9 days' time. Once we've picked our stock, we can go into the short straddle screener and add a parameter that the symbol needs to match the one that we're interested in. And here we can see some example short straddle trades. So we're going to take a look at the first one, expiring on December the 2nd after earnings. We're basically selling an at-the-money call and an at-the-money put. This is what the trade looks like. You can see the profit potential is if the stock stays where it is or if it stays within the expected range. And the break-even price on the downside is about 135 and on the upside about 161 or 162. Notice that it's negative vega, so it will profit if volatility drops, and it's also positive theta, so that means it's going to make money each day through time decay. Here's a previous example. Some people will like to trade this strategy over earnings. As I said earlier, it is risky because sometimes the stock will make a big move, but in this case, we see an example where HD didn't move very much after their earnings announcement. There was a big drop in implied volatility, which generally occurs after that unknown event has occurred, and the trade ended with a nice profit. So we can see here, stock was trading at about 310.55. We've set up a short straddle here with 3 days to expiry, centered at the 310 strike. And the next day after the earnings announcement, the stock's trading around 308.75. And the trade's made a nice profit of close to $700. You can see here, 4 days to expiry, the day before the earnings announcement, volatility is about 67% IV for implied volatility on both the puts and the calls. After the earnings announcement the next day, implied volatility has dropped to 46% and 45%. So that's how the trade makes money around earnings, provided the stock stays within the expected range and it doesn't move too much. Obviously, that was a winning example. Let's take a look at an example that didn't work so well. AAP, similar setup. The stock's trading at 184 and 3 cents. this trade was centered at 185, so selling the 185 call and the 185 put. And the next day, the move was 15%, much larger than the expected, and that's what can happen when the trade doesn't work. So it's always good to be aware of what can go wrong. In summary, short straddles are very popular with theta traders due to the high level of time decay. However, traders need to weigh up that benefit with the risk of the stock making a big move. This strategy has very high gamma, which means big moves in the price of the underlying will have a significant impact on P&L. When it comes to short straddles, a good rule of thumb for taking profits is if 50% of the premium has been made in less than 50% of the time. Stop losses should be set at around 1.5 to 2 times the premium received. Trading short straddles over earnings can be very risky and allows little room for adjusting or implementing a stop loss. Short straddles that are close to expiration have a high level of assignment risk, and the option strategy is not recommended for traders with less than 12 months experience trading real capital. Hope you enjoyed the video, and we'll be back with another one shortly, and have a great week. We'll talk soon.